Good morning. So I'm delighted to welcome you to a new location for PEM, to the fantastic Babraham Research Campus and PEM's 2023 budget seminar. We're also live streaming this event, so good morning to those who have logged on and now joining us. So throughout the presentation, we're going to be using Slido, which most of you will have seen at previous events. The details are behind me, so if you haven't downloaded the app yet, please do. It will allow you to ask and rank questions and comments, and it's anonymous, so we won't know, I promise. Please do send through your questions during the presentation. We'll be picking out the most popular ones and hopefully the most interesting ones and get some answers from our experts here. So a little bit the usual housekeeping. No plans for fire alarm testing if the alarm does sound through the doors here, and then downstairs and out through the front, and there is a meeting point just outside the front of the building. I hope you've had a chance for a chat with some of the PEM team, coffee and a very good bacon or sausage rolls. Once we've finished up in here, our speakers are available for any questions, and we've also got a large selection of our tax team as well. So we've got a fairly tight timetable and we're 1 minute behind, so it's not so bad. We're trying our best to keep on track. We're aiming to finish by 10 o'clock, and that will include a brief Q&A session at the end. So we're back in our usual sort of spring slot for budgets, and has become the norm over recent years. A lot of it has been leaked already, gently leaked from the weekend and the last few days. If you managed to hear anything over the BBC Lineker Gate at the weekend, you would probably have seen a lot of info on pensions, but that will be covered in a bit more detail. It's only actually 6 months since we had the ill-fated truss, and I think we'll call it the kamikaze statement, which sent the UK markets into a bit of a tailspin. This, together with high inflation, high interest rates, and stagnating growth, has proved quite a challenging environment for the Chancellor, and I think probably has reduced the wriggle room that he has for big announcements. But actually, maybe in the middle of a significant downturn, with pressure on cost of living and public sector strikes, it's good to have a very safe but unspectacular Chancellor. And while his jokes are even worse than mine, perhaps a boring Chancellor is what we need right at the moment. So what did Jeremy actually have to say? Well, the outlook for the UK economy is not actually as bad as some of us feared, with inflation due to fall perhaps quicker than predicted. The aim of the budget really was to address lack of business investment, and also getting the UK workforce back up to full strength, with key measures on investment tax relief, removing pension restrictions, and increasing support for childcare provision, more of which to follow. There was good news for Cambridge and the wider region, which, given our location today, is quite fitting. There's investment into life sciences, the creative sectors via R&D tax credits, investment into AI and quantum computing, and I'm sure you'll have seen the £1 million annual prize for the most groundbreaking UK research into AI. So good luck, everyone, with that. Each budget seems to include an announcement on the East-West Oxford-Cambridge rail link, which I think, having done this for about 8 years, is the annual comment. Good news that a decision on the route between Bedford and Cambridge is going to be announced in May. Now, if any of you are on that route, clearly that's not good news, but we are making progress, and the project should begin in the next year or so. So let's crack on. I'm delighted to introduce you to Matthew Eady and Fachot and Sanchia Norris, who will be guiding you through the delights of employment tax, business taxes, and personal tax. So Matt, over to you. Thank you.
Good morning, everybody. As I said there, I was glad the Slido picture was because everyone's phone came up, and I thought maybe they'd take a picture of me as I was talking, so that was a good timing.
It's the only slide I've got today.
Yeah, thank you. We had the introduction, no view. Here's me. So this is the Chancellor's first budget. So Warren has already explained that we had the mini budget in September, the market fallout arising from that. Jeremy appointed as the calming measure. It was quite boring, and he didn't have much to play with in his budget yesterday. He's the third Chancellor we've had since the last budget in October 21. So just one of those Chancellors hasn't actually had a chance to give a budget. He was in office for only just a few weeks. There wasn't many rabbits out of the hat that he could pull out in his budget. As Warren has said, a lot of the information was leaked to the press beforehand. What he didn't say was perhaps interesting, and we'll come on to that. So the frozen allowances, the fiscal drag, which we covered back in our November update, that's still there. The concept that we have the highest tax burden since the Second World War, the fact that he's given a budget with high inflation, high interest rates, high energy prices, public sector strikes, really didn't give him much room for manoeuvre. However, what he did say is that he wanted a budget that was for long-term sustainable prosperity. I think that's every budget, every Chancellor's goal, really. It's the opposite of that. It's probably not worth having at all. There was a YouGov poll yesterday, which probably showed the indifference of the population. So 56% of the respondents said it probably didn't really affect them. So that's probably a sign of just how much interest that the wider population took. Interestingly, this is the first budget that's coincided with Cheltenham Festival. So you go back to 2004, that was the last time. At that time, society may have changed a bit, but there was Tory MPs calling for Gordon Brown to resign because people couldn't watch the budget. And I think that indifference now is quite interesting. It was a budget for everywhere. He'd obviously been to school, worked out that he could use the 4 E's. Everywhere here, read levelling up, but L really didn't work in the concept. A couple of years ago, that may have said Europe, but we've moved on from that. Actually, his only mention of Europe was to do with beer and frozen duties on there in draft beer, I think. So not a great deal mentioned. It is a budget for everywhere. It is a budget for him. Warren has already discussed the various aspects. I think it was good timing that we've had this venue today compared to Fachot, because that's where this budget is probably aimed at. It could have actually said 4 Ps. So for those of you who work in marketing, the 5 Ps, 6 Ps, however many Ps there are in marketing, it could have been the 4 Ps. So pubs, pool, given Rishi Sunak's swimming pool debacle, potholes was mentioned, and preschool. But I don't think that would have been a really exciting budget for the hour and 5 minutes that he spoke for. From an employment tax perspective, not a great deal to get excited about. Perhaps it really wants to focus on what we think employers may be impacted in due course. And his employment pillar is where he's going to try and encourage his growth. Statement that 6.7 million people of working age are currently inactive. Now, that might be because of ill health or disability or early retirement, but that figure is higher now than it was pre-pandemic. So it's 21.3% of the working population. That's where the Chancellor believes there's room for more people going into the labour market, more people in the labour market working, better for the economy, more taxes. This is a measure that apparently is going to cost £7.1 billion. Now, the majority of that is going to be in childcare and facilities for working parents. That is unravelling by the day, so whether that's still going to be here by the time he does his Next election, which interestingly may well be a in its budget, may well be a pre-election budget, maybe more room for giveaways. The key role for employers in this is how do you facilitate this goal of improving and increasing those in the labour market. The Institute of Fiscal Studies said of that 7.1 billion, that is only going to lead to 110,000 extra people working, which is about £70,000 per extra person that's employed. Whether that's money well spent remains to be seen. For employers to help, there'll be consultation on areas such as occupational health services. So at the moment we have exemptions in the tax code for medical screening, whether that's going to come in, maybe subsidies for that provision, but also flexible working. So 3 years ago, as it went into lockdown, most employers worked at their employers' premises or at clients. Lockdown, actually, it turned on its head overnight. So 40% plus of the working population were working from home. That is where the Chancellor believes there's room for manoeuvre. People that can work from home but potentially can't get to an office environment is good for growth. So we see flexible working as one area that he will target. The increased offer of flexible working by employers. There's aspects, there's some employment lawyers here today, but there's some rules going through legislation about the right to ask for flexible working from day one of your employment. And a government call for evidence on ad hoc flexible working. What hasn't happened, what wasn't announced during his talk was how that interacts with the tax code. So the employment tax provisions have been in existence for a number of years. This change, how we work, is not yet reflected in that tax code. There was a report published by the Office of Tax Simplification end of last year. That was their last report before they have been disbanded, just on this area and the differences between if you are permanently based from home, if you are working under an informal arrangement, or if you have a formal arrangement. What's the differences between tax treatment of your commuting costs? Is it home to office travel? Is that tax free if you reimburse it or not? If you provide equipment for your employees, is that a taxable benefit? If they buy it and you reimburse it, that's going to be taxable. So that is an area that was relaxed during the pandemic, but those rules have got tighter again since. What about electricity or heating costs? How do you get reimbursed for those if you're working from home, depending on whether it's for or for arrangement? And that's not to then say there's even more issues if you have overseas employees. So we saw in the pandemic, people were trapped overseas because they couldn't get back because of all the flight restrictions. That now is quite a regular occurrence. It's really great that people can work overseas and still do their role here. But what do we have in terms of payroll implications, social security, immigration, visa issues? All of these areas need to catch up with the Chancellor's idea of having flexible working. I think Spain are moving in the right direction with a nomad visa. Maybe we'll catch up with them as we go through these rules. The new word actually for the budget was this returnerships. Not heard of it before. We'll probably get to hear about it more. And it's apprentice style program, not only Alan Sugar variety, but that might be more interesting going forward. Targeted at the over 50s to retrain, reskill, to keep that age group in the labour market. The Chancellor made a joke during the presentation during his budget, which didn't actually go down so well in terms of the speaker. But he also said he's over 50 and has retrained, gone to different departments, so he put himself in that category. He uses other countries as he needs to. So his example here was Sweden. If in that economically inactive group of people aged 50 to 64, which is 3.5 million at the moment, if we matched Sweden's rate of employment, we would have 1 million more people in employment. And that's what his target really is. So there's no news yet about whether this will fall within the apprenticeship levy, whether it will be part of that, but that will come. Potentially opportunities for a second career. We've spoken to Derek already, as he retires in a couple of weeks. He chose to have root canal surgery this morning rather than coming to. I think myself and the rest of the team maybe see if we can get him in this apprenticeship going forwards. It's one of those areas also where tax needs to change also. If we have employees who are of 50 and over and they have their employment terminated, generally you're looking at termination payments being taxable. Is that really correct in a world where age discrimination isn't permissible? On to employee share schemes. What wasn't announced during the budget was some really quite fundamental changes to EMI. So the EMI option, enterprise management centre, has been around since 2000, really crucial, particularly for companies where we are today, to recruit, retain and motivate key employees. Limits have generally gone up over time. Tax treatment has changed, but is aligned with business asset disposal relief. What does change, though, is HM Revenue and Customs guidance. In August 2016, they changed the guidance overnight on this thing called restrictions. So if you grant a share under option and it has restrictions, you need to tell the option holders all about those restrictions. A lot of option schemes didn't do that, and there's been 7 years now, HMRC clearances, due diligence problems, options pertaining to be EMI qualifying are not, and that only tends to come up on a transaction. That rule is being scrapped on the 6th of April, which is good news for people to have subsisting options, because actually it's not just from new options from the 6th of April, it's for all options that haven't been exercised. So if you have schemes that don't quite meet that criteria, that provision is going to be grandfathered. And I wonder whether that's because the revenue just sped up with all the clearances they are receiving. The working time declaration, again, that's going to be removed. So there's another admin issue that often gets overlooked. So someone's got to sign this when they have an option granted to them, and the company has to tell HMRC that they've signed it. That comes up on due diligence as well. That's being scrapped in this April. And the actual process for telling HM Revenue about a grant of option, that's going to change from April 24. So rather than it being within a very short 92-day window, it's going to be done after the end of the tax year. The simplifying measures. That then leads on to other discretionary schemes with a call for evidence, where we potentially would see changes coming into the next election. The limits on share incentive plans, for example, are ripe for increasing, I think. Anti-avoidance is always mentioned in the budget, so it would be unfair not to talk about it again now. But what was mentioned in the budget notes themselves and in the accompanying documentation wasn't that informative. The promoters of tax avoidance schemes, if the revenue tell them to stop and they don't, then that's now a criminal issue. And the doubling of a jail term for the most egregious of tax fraud. I don't know what egregious means here in tax fraud. It's not defined. There's no thing to compare it to. But if you do it, rather than going to jail for 7 years, it's now 14 years. And a bit more funding from HMRC tax debt collection, which is good news for the revenue. But recent history on that is not particularly good for HMRC on this taxpayer protection task force. This was introduced in April 21 after furlough had been with us for a couple of years. You'll all remember furlough was introduced in the middle of a rush. Guidance came out every Friday evening, it seems. Legislation was pretty unclear. The revenue thought about 10% of all claims of 69 billion were made in error or there was fraud. So this task force was set up to try and recoup some of that money. 1,200 people moved from different departments into this with a goal of collecting that 6.9 billion back. First year, 640,000, so some way to go. So that's being disbanded, winding up this year. What I think that does mean, though, is all of those 1,200 staff who have been concentrating not very well on furlough claims will now be concentrating on other inquiries, whether that shifts to employers, whether that shifts to R&D tax credits, which will cover in more detail, in a £469 million per year error and fraud calculation. So to sum up the employment tax area, I think very little in the way for employers, but watch this space, but the tax rules need to move with the times as to what the Chancellor wants to achieve.
Just stand over here. Okay. Thank you, Matthew. Good morning, everyone, and welcome to the Bateman Research Campus. I had a quick look at the website, and it's one of the best places for starting and scaling up a life sciences venture. So I think a lot of the announcements that were made on Wednesday were very much targeted for businesses in the Bateman Research Campus, in Cambridge, the region. I think generally positive for the UK generally. I think we had a lot of upheaval, which has already been mentioned in the autumn. We had the rate rise, which was scrapped, and that was then scrapped again. So a lot of upheaval in terms of the corporation tax rates, but hopefully there were some positive announcements on Wednesday for businesses. So today I'm really going to be covering the enterprise bit of the 4 pillars mentioned by Jeremy Hunt of the enterprise employment education everywhere. So really, in terms of the 3 subjects I'll be covering, is going to be R&D. It's something I've been probably discussing for most of the budgets the last few years. I'll also be covering capital allowances and also just a review of where we are in terms of the corporation tax and how competitive we are in terms of the global economy as well. But I think the government also mentioned in their documents that there's 5 key areas of growth globally that they're looking to capture. And these are green industries. I think last 12 months with the energy costs and the issues regarding the invasion of Ukraine has meant that there's been a refocus of energy dependency and green energy. So there's going to be a lot more regarding nuclear, renewables and carbon capture. And I think quite a lot of it's going to be in the east of England. There's also a lot of announcements regarding digital technologies, which I think Warren alluded to, and AI, which is so important to other areas of research and science. They're talking about AI supercomputers investments and also the compute and quantum technologies as well, which is going to be really helpful in accelerating R&D. They're talking about a lot of innovation accelerators, although these are going to be part of the everywhere pillar of Jeremy Hunt, which is going to be mainly in Glasgow, Manchester and Birmingham. A lot on life sciences, which we touched on East-West Rail Line. There's also going to be a boosting measures to boost supply of lab spaces and also acceleration of the MHRA approval process from 2024. And there's also a lot, there was a very passing reference that there will be continuing supporting creative industries and advanced manufacturing, and to look out for further announcements in the future on those areas. So in terms of R&D tax relief, this has been a very important aspect of the government and preceding governments as well. It's been R&D tax relief were introduced in 2000, 2002, and they've been improved quite significantly over the last few years. And there's been constant change. But it's something that's actually now that people are a lot more aware of that. There's been also a lot more fraud. And the National Audit Office actually mentioned that in 21-22 there was £469 million of fraud involving R&D, and most of it is SME, and it's because there's been a lot of advisors and really pushing the boundaries in terms of R&D claims. So they're looking at the relief more closely, and they are also being a lot more rigorous in terms of the R&D process and claiming the relief. Just a reminder in terms of the R&D scheme, the slide you've probably seen before, there are 2 main R&D schemes, one for large companies and one for SMEs. SMEs are defined as enterprises with no more than 500 employees, €100 million turnover, or €86 million balance sheet assets. Still, from the fact that we were part of the European Union, those tests, so those might change in the future. And the large company scheme is given as called RDEC, is given as an above the line credit, which basically means that you bring in some income, and that's tax for corporation tax purposes. At the moment, the gross amount is 13%, applying a 19% rate rate of tax is 10.5% benefit that you get back on the RDEC scheme. In April 23, the gross amount is going up to 20%, the corporation tax is going up as well, and the net benefit will be 15%, whether you're tax paying or loss making as well. In terms of the SME scheme, that's the one that really most people try and get into. And the first step is really to give an enhanced deduction, which is currently 230%. That is going to reduce down to 186%. And applying the corporation tax rate, that gives you a net benefit and saving of 43.7% if you're tax paying currently. The amount is actually reducing down to 186% and at 25%. So there's going to be a slight increase in the benefit on qualifying expenditure. But if you think about it, all the other activities which are not covered by R&D, any other taxable profits are going to be subject to a higher rate of corporation tax. So businesses are going to be overall, tax-paying businesses are overall going to be worse off, even with the increased amount of relief they have on R&D. The repayment credits, that was a surprise announcement in the autumn, because at the moment the 230% is surrendered at 14.5%, which gives you a net benefit of 33.3%. So if I spend £100,000, I get £33,000 back. That was reduced quite drastically in the autumn statement to 18.6%, which was a bit of a shock to quite a lot of people. And there was a lot of representations from professional bodies and advisors, and they announced on Wednesday there's going to be a new category of R&D intensive businesses. So if you spend more than 40% of your expenditure on R&D, you have a separate category where you can effectively claim just under 27% R&D tax credit. So not as generous as it was before, but I think that was a very helpful change that was announced on Wednesday. So I think just to illustrate that in terms of £100,000 spend, at the moment on the RDEC, you would get roughly about £15,000. It was 10,350, so that's an increase from this April. There's a decrease under the SME scheme from 33,300 to 18,600, and fortunately we've got this new R&D intensive category, which basically gives you effectively £27,000 of R&D tax credit if you've got sufficient amount of losses. So in terms of things that we already knew and some changes, something to be aware of, cloud computing costs, data cost, and pure mathematics used in R&D can be now included from 1st of April 2023. However, as we mentioned, HMRC are looking at claims very, very carefully. So they're looking at a lot more information about who the advisors are on R&D claims. Apparently there's a task force, and HMRC have, I think, identified 80 advisors where they are looking a bit more closely about claims they've made on the website, having 100% success rates, very good relationships with HMRC, and they are going to be contacting them very shortly. There's going to be a lot of upheaval in this area. Also, notification of first-time claims. Currently, you have 2 years from the accounting period ends to make an R&D claim. But if this is the first time you're doing it, from 1st of April, you've got 6 months to notify HMRC from the accounting period end if that's your first R&D claim. So from that perspective, you do need to start thinking about if there's companies that's eligible for R&D to claim it as soon as possible or notify HMRC. And there are a lot of measures that we're expecting to see over the summer as well. I think they're talking about online reporting and information that they expect to see people being putting R&D claims without reports. HMRC saying that we need to have some basic information about what the qualifying expenditures are, what the spend is, and they'll be a lot more rigorous. At the moment, they are aiming to process 97% of claims within 28 days. I think a lot of them are going up to about 40 days. There is actually a suggestion maybe that it should be 60 days on the basis that it will mean that HMRC will look at those a bit more carefully. In terms of the future, we were expecting to see a lot more restrictions in terms of overseas subcontractors following Brexit. The UK now can be a lot more targeted in terms of the R&D tax relief, and they're looking at UK activities, but that is going to be delayed until 1st of April 2024. So really, I think a key point is to think about your accounting period when it starts, and it might be worth just thinking about possibly changing it so you might be able to benefit for another period of time under the if you've got quite a significant amount of overseas subcontractors. In January, we had a consultation document. They are talking about merging the two R&D schemes, and that's going to be quite tricky because you've got the RDEC on the one hand, and then you've got the SME scheme, and there are quite a lot of differences between the two schemes. For example, the treatment of subcontractors under the SME scheme, is much broader. You have a 65% restriction, but you can include a lot more into the SME scheme. For the RDEC, it's only work that's been subcontracted to individuals, qualifying bodies, and partnerships constituting of individuals. So when you merge the two schemes, hopefully they'll go more down the SME route rather than the RDEC scheme, which is a lot more restrictive as well. So I think that's going to be a lot of interesting measures. I think over the next 3 to 6 months, there's going to be a lot of things going on in terms of R&D tax reliefs. Now, I've included creative and cultural sector reliefs. They operate very similarly to R&D. They give you an enhanced deduction, which is 180%. And in the vast majority of cases, theatres, orchestras, museums are loss-making, so they can surrender those enhanced deductions for a tax credit, which is shown on screen here. There was also a separate consultation document in January in terms of reforms to the audiovisual tax reliefs. I mean, these are really high-end productions. You're talking about a minimum £1 million spent per hour of production. So these are being reviewed. They are also thinking about moving to a above the line credit, very similar to your RDEC scheme. And the reason we're seeing these shifts is because the UK is part of the OECD commitment of Pillar 2, which is the global minimum tax of 15%. By having an amount of income which is taxed, actually your effective rate of tax is not going to be caught as quickly using the above the line credit. So it's really aimed at enterprises where there's more than €750 million turnover. So film studios, large companies such as the ones that are covered by the RDEC will be hopefully compliant with the new Pillar 2 reforms that are coming in later on this year. Capital allowances. There was a lot of announcements regarding capital allowances. There were a lot of measures coming to an end as of 31st of March 2023. They had various measures to encourage capital expenditure. People were aware of the corporation tax rate rises, so they were boosting the allowances that you could get to encourage people to spend and not to defer until 1st of April 2024. Capital allowances, there are various categories: plant and machinery, special rate pool, structure and buildings allowances, and there are and the tax treatment will really fall depending on which category those fall into. So first of all, the super deduction is coming to an end as of 31st of March 2023. It gives you 130% first year allowance as opposed to the 18% writing down allowance. We've also got a 50% first year allowance on integral features. Most people have been looking at the super deduction and the annual investment allowance for the items which are on the special rate pool, but there was a 50% first year allowance also available. And that the reason was really to encourage that spend before 1st of April. There are some careful considerations where you've got accounting periods that go over 31st of March, how those allowances are applied. But I think, we've also had some welcome announcements that were made in the autumn statement regarding the annual investment allowance, which is fixed at £1 million. And one of the measures that we were all looking out for, because there was a lot of discussions in the business tax team, very exciting, I know, in terms of the transitional rules that will apply from 31st of March 2023, where you had to possibly have to apportion, if you had a period between the 1st of April and 30th of June, you would have to time apportion it. So you might think, well, I'll save £1 million for the following 3 months period. Actually, that would have been restricted. So those transitional rules have been repealed, and that's a welcome change. In terms of the budget day itself, there was a lot of fanfare about full expensing, and that is a kind of a response following the end of the super deduction. And in the absence of these changes, apparently the UK would have moved down to about 33rd most competitive capital allowances regime. By having full expensing on plant and machinery, I think we are joint first in the OECD now. So that basically means that in most plant and machinery items, I've got a list of items on there, IT equipment, all those items can be within that new 100% FYA. So you're going to have to think about whether you claim the annual investment allowance, whether you claim the first year allowances. Crucially, these do not include cars. It needs to be new and unused assets, no, not second-hand. And these are applicable to companies as well. I know I'm covering business tax, but this is just companies which are subject to UK corporation tax. And the measure is going to be in place for 3 years. They are saying that as soon as it's economically viable, they will be looking at making this a permanent change, but a lot can happen between now and 31st March 2026. As I mentioned, it excludes cars, and also you have to be careful with leasing. A lot of group situation where you might have one company having the assets leasing to another entity, then you have to be very careful with the first year allowances and seek professional advice. We have a separate category here of first year allowances for integral features, very much an extension of what we had previously. So I think there's a lot of options now. You've got the annual investment allowance, you've got the 100% first year allowances for plant and machinery items, and 50% integral features. So hopefully, we are talking about corporation tax rate rises, but hopefully these are right measures by encouraging capital expenditure, R&D, and so on. In terms of corporation tax, this is my third and final session, and really what you can do. I mean, very clearly, there's been a lot of press about this over the last 3 or 4 years. First in 2021, when we were talking about the plans to increase the corporation tax rate, then we had Kwasi Kwarteng scrapping it, and that was quite an interesting time for us. We were having a conversation with clients. Some international clients were saying, really good news that you're not going ahead with 25% rise. Then you had to pick up the phone again and say, no, we're going ahead with 25% rise. So it's just been very tumultuous periods. So we've got now 2 rates of corporation tax, which is going to be fun for our students as well, having to work different tax rates. We also have a marginal rate as well. So what we have is the main rate applies for typically over £250,000. Small profits below 50,000 will still have a 19% small profits rate, and between 19 and 25%, between 50,000 and 250,000, there's going to be an effective tax rate of 26.5%. So I think a lot of planning in terms of profit extraction and what you do with the company is going to be quite crucial. And those thresholds of 50,000 to 250,000 are going to be impacted, but if you've got shorter accounting periods or associated companies, this is a concept that we had many years ago when we had multiple rates. It's being brought back in. So at the moment, a lot of tax payments and reviewing the position is in relation to groups. Associated companies will apply where one company controls another, or multiple companies, but it also will cover where the same person or same persons control a number of companies. So now might be a good time to look at your structures and simplifying those, especially because of the rate rises in terms of corporation tax. So to finish off, where are we in terms of corporation tax? We were the lowest in the G20, close to Russia, which is probably not a good thing. We are now, in terms of the IFS is saying very much, middle of the road, but we're still the lowest in the G7. And I think clearly we can see the rates going up to 25%, but some of the measures in terms of the R&D, the capital allowances, will hopefully help to make the UK still a very competitive environment. On this note, I will hand you over to Sanchia to cover the private markets. Thank you.
Jan. Morning, everybody. It's really nice to be back here in person. I don't know if any of you had to bear watching the last one we did. It was online and it's not my favourite thing. So thank you for coming. At least seeing familiar and new faces in the audience just makes the whole day run a little bit more smoothly. This was a really personal budget. I thought he was talking to me. Over 50s, experienced, skilled, able and talented. So it's about me and on with the budgets. What are we going to look at this morning? Making tax digital. Going to do it. We have to. Crypto. It's personal. It's still personal. What should you be doing now, immediately, and what should you be doing after 6th of April? We're running a little bit late, I think. So I recommend you do bear with me because the last 2 slides are really interesting. Making tax digital. I'm so bored with making tax digital. I've been talking about it since 1850. Feels like it. Since autumn 2015, it might be here in 2026. Who knows? I might be retired before it comes in at this rate. I'm going to park it. Crypto. I don't really understand crypto. I think it's because I'm an experienced person. If you're 12, you do understand it. And Mummy, you should have some of these. I don't, because I don't understand them. But they have been moving up and down in value. People have been taking advantage of that and having huge gains. And oh my goodness, it's taxable. It always has been. And lots of people didn't know that, apparently. So again, we've been talking earlier about different inquiries that are coming out. We haven't seen any inquiries on this yet. We've seen the odd nudge letter. We think you might have some of these. Have you put it on your tax return? Is it relevant? Do you want to look at it again? So I'm just saying, if you understand these things and you've got them, one, please get a tracker app, because they're a nightmare for us to follow and calculate the gains on. The tracker app looks at every single movement, and you can just pull it up on your phone, apparently. And it tells you what the tax position is, because it's going to have to be reported specifically from next year onwards. It's going to have its own set of pages. We don't know what they're going to say yet, but it's obviously very important, and the revenue are fishing for money that they think is lost. So if you've got crypto, have a look at your circumstances and make sure it has been on your tax return. If it hasn't, come and talk to us, we'll help you out. So we talked last time we were here about some frozen thresholds. It looks like good news, partly, but some of them are starting to defrost. Some of those might look a little bit more attractive, although how it's going to look better than Botanic Gardens a few weeks ago, I just don't know. So let's have a little look. Tax thresholds and allowances. The only interesting one really here is the additional rate band. Tax is moving downwards. It will now be aligned at the point that you completely use your personal allowance. It's going to make the tax bands easier to calculate, because you'll go from 0 to 20 to 40 to 60 back to 45. That sounds easier than having an extra 40 pop back in there. So I think watch this space. Obviously, they're collecting more tax. This is better for them. But it's not going to make life terribly interesting. The dividend allowance, we've had lots of our clients who have organised their affairs, so they have no more than £2,000 worth of dividends. It's going down and it's going down. So those people who have got out of self-assessment might find yourselves back in it again. Watch that space. Capital gains tax the same. The annual exemption is coming down over £12,000 in the current year, 6,000 and down to 3,000. So more comfortable thresholds going forward. You know it's coming. We're going to talk about pensions. This seems like really good news. Your pension allowance, the amount you can put into your pension every year, is going to increase from £40,000 to £60,000. If you're a lucky person and you're earning too much money, your take-home allowance is going to go up from 4,000 to 10,000. And if you're already drawing your pension, your money purchase annual allowance is also going to go up to 10,000. But really, are they going to abolish the lifetime allowance? And what does that mean? Currently, it's set at £1,073,000, I have to read it, £100. That's what it is. If you go over that, you're in taxable circumstances, and most people have tried to avoid that. But it's going to be abolished. Is it really true? What does that really mean? What happens is that you can take a tax-free amount at the moment and going forwards, and hear that again, and going forwards, the tax-free limit is fixed at 268,275, a very convenient number, which I can't remember. I'm going to forget it within 2 slides from now, but you can take that out tax-free. Anything over and above that you take as a lump sum is going to be taxable on you, and this is what is changing. So at the moment, there's a tax charge, and you pay a flat rate of 55% on the amount you withdraw above that. That's what's changing now. We're going to a marginal rate of income tax, which might or might not be better. So for some people, if you have no other income in the year at all, you might find that you're only paying at 20% on the excess, or 40%, or a combination, or 60%. Is that better? I'm not sure. 45% again. So it depends where it fits in your marginal rate of tax. And it's, you know, standard tax rules. Is it going to be good for you? Depends. So let's have a quick example. And I'm going to talk about protected pension pots and unprotected pension pots. Most people, I'm imagining, have no protection on their pension pot. So years and years ago, when they started to change the rules of pensions, if you had a hugely valuable pension that was worth more, or you projected it was going to be worth more than the pension lifetime allowance, you were able to protect it so it wouldn't be taxable, and you elected specifically to protect it. This is a circumstance where you didn't do that. So let's say your pension pot is £1.3 million and you want to take out a 25% lump sum. It doesn't matter if you do it this tax year or next tax year. The taxable amount is going to be the same because you're looking at that limit of 268,275 being tax-free. Everything above it is going to be taxable, but it's the rate of tax. So this year you'd pay £31,000 worth of tax. And next year, I'm assuming you might have a little bit of basic rate and the rest of it's at 40%. You might only pay £21,000 worth of tax. So for people in those circumstances, it's definitely going to be beneficial and you will have a tax saving. So let's talk about those people who elected years ago to have protection. Same pension pot, 1.3 million. They still want to take 25% out. They can have the whole amount, £325,000 tax-free. That's great, isn't it? I'd rather be there until they started to change these rules. Because if you're in a protected pension pot, you cannot put any more contributions into it. That was the deal. You signed up to protect it, you can't add to it. So you're now in a position where the government is saying, well, we're moving the cap, the lifetime allowance is gone. What are you going to do? Are you going to say, oh, it doesn't matter because going forward, there is no cap and therefore I could break the protection. I could make more contributions. You only need to put £1 more in and you've lost your protection. Or you could put £100,000 in. That would be better for your pension pot. My concern is there's a question, is it better to have that protection and understand that, or is it better to have the flexibility to increase your pension pot? Now, if you're a hugely wealthy person who's got a massive pension somehow and you're only 30, it might be better to break that and increase your pension pot. If you're more like me, and I don't have a huge pension, but if I did and I was in protection, I might be saying, well, actually, it's not that long until I retire. So guess who I'm going to talk to? My IFA. I'm going to be saying, let's get some professional advice on this. What's the right thing? And then the other thing is certainty. And that's the one thing you don't have when your government fluctuates from one party to another every time there's an election. Because we know at the moment that Labour have said, we don't like that. Guess what's going to happen if we come in? We're going to put it back. And then what happens if you've lost your protection? Don't look at me, I don't know the answer. So who's going to benefit? There's been a huge amount of spin. All I've seen in the papers and on the news is pension, 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 pension. It's disgraceful. The really wealthy are benefiting. So let's look at it. Are they really? So who's going to benefit? Yes, obviously, those who've got high value existing pensions, they are going to, if they want to break their protection, they could top it up. Certainly they could benefit. If you've got a lower value pension or you're a lower paid person, I suspect it's of no interest to you at all. Or if you're a middle earner. Now, these are the people that the government were targeting. These are your consultant surgeons, not even every consultant in the NHS. This is stemmed from a survey from consultant surgeons who were retiring early because of the pension disadvantage to them. So for that very small group of people and everybody else who falls in the bracket, you can now contribute up to £60,000 a year. Now, the government want you to work for more years. Let's say you work for 50 years. I mean, for goodness sake, that seems a long time. But if you can put in £60,000 a year as a middle earner, that's £3 million in your lifetime. Is that going to encourage you to work longer or retire earlier? I wonder. High earners, by contrast, can only put 10,000 in. And let's say they work for the same 50 years. That pension pot is not as appealing. It's a lot smaller at £500,000, isn't it? So is it going to incentivise them to work longer? Your guess is as good as mine. But what does it really mean? So the accusation over this over these pensions is the IHT saving that you can get. How and why does that work? So it's all about really wealthy people being able to protect their assets, even if they're not the middle earners, and they can relieve their pension, and it's outside of inheritance tax. It's really interesting that the rules that have come under fire here are not new. They have been enhanced by the removal of the lifetime pension cap, but these are not new rules. So what actually happens? The important thing is the pension fund is outside of your estate of inheritance tax. So anything that's in it will not pay 40% when you pass away. You can make a payment in every year, and up to the annual allowance, there's a tax relieved cap. What happens if you pay more than the tax relieved cap? And that's where this is hitting. So if you make more than your annual allowance allowed amount, the contribution goes into your pension, the government top it up. And because they're topping it up, and because they don't want you to do this, they then levy a charge for your tax return to recoup the tax lost. So the question is that charge worth the IHT saving? Let's look at a quick example. So you've already made the pension contributions that you're allowed to make. You've got taxable earnings of £500,000 here. If you do nothing, and don't ask me why, I've used the wrong year, and I realised too late. So if anyone here is calculating this, I've used the 21-22 rates. I'm sorry, I can rework it. The tax and national insurance due is £221,000. If you overpaid your pension, what would actually happen? You put £100,000 into your pension pot. The government puts £25,000 into your pension pot, because that's how it works. You will then have a tax charge, and that increases the tax that you pay for the year, but only by £25,000, which is the amount the government have put in your tax pot. So what have you done? What have you lost? You have paid £100,000 into your pension. You've paid an extra £25,000 worth of tax. The pension pot has got £125,000. Have you lost anything at all? But have you gained anything? What you have gained is £50,000 of inheritance tax that will not be paid in due course, because this is in your pension fund. This has only ever been appealing to people who are never going to touch their pension pot, because once you put your money in your pension pot, to get it out again, once you've gone over your limit, you're going to pay tax. And that's tax that you could leave in your bank, but capital you could leave in your bank and not pay tax on. So if you think you're going to need it, people don't do that. Generally, in my experience, there aren't very many people who are massively overpaying their pension pot. Whether more will now, and they will take advice, no doubt, from their IFAs, who knows? And what happens if we have a Labour government and they change the rules? So seek investment advice. I can't say that strongly enough. I don't know what they're going to tell you. Hands up, any ideas? So what should you do now? What should you do now? This is really back to basics. I'm not going to go through this in any great detail. You know the rules: pay your pension, use your ISA allowance, use the dividend. If you're sitting just above a rate of tax, you could reduce it by making a gift aid payment, using a tax reducer. Should you use your capital gains tax exemption? I would this year, because it's going down next year, and use your inheritance tax allowances. Just do it. If you haven't done it, now's the time. You've just about got time before the 5th of April. What should you do after 5th of April? Well, obviously, all of those things again. Don't leave it, because we might not be here in March for me to remind you next year. So get on and do all of those things as you would normally. Other things you should be looking at is perhaps balancing income between spouses. If you've got a spouse who's paying tax at 60% because they're losing their personal allowance, maybe for next year you can look at, could we reduce their income? Even if their partner, husband, spouse, wife is paying more at 45%, that doesn't matter, does it? Or you might have an opportunity to bring them both below the 100,000 limit. So have a look at it, see if you can balance it. Everyone's really keen on adult children, supporting for university costs and things like that. There are things that you can do. Again, let's have a look at it in detail. And the last thing I want to leave with you here is consider your profit extraction. So Jan has talked to us earlier today about changes in corporation tax rates. We've got some nasty marginal rates coming in there and a higher rate as well. But it basically means that if you're in a company, you're going to be paying more tax. So how does that impact on us as individuals? Let's have a little look. So I've got a company and it has already, let's assume it's done the right thing. It's paid the national insurance limit. It's made as many pension contributions as it wants to. It's claimed every single relief it's entitled to, and it's still got, hooray, £250,000 worth of profit. What's it going to do with that profit? Is it going to leave it in the company? Could do. Or is it going to pay it out? In this case, the shareholder needs the money. So he's having a conversation with us. How do I take this out? Do I take this out as a salary? Do I take it out as a dividend? Historically, for as long as I can remember, we've always said the rule of thumb is take out the national insurance level salary, top up your state pension, and then take it as a dividend. It is beneficial to do that. But the tide has turned. If your company is in the marginal rates, or if it is paying higher rate corporation tax, it is now going to be cheaper or more beneficial to your pocket to pay a salary, not a dividend. And that's going to be more beneficial to the revenue pocket as well, because it means that you'll be taxed through PAYE and your tax will be paid earlier than if it was by way of a dividend. So for me, this is a really big take home for all of us who are working with clients in owner-managed businesses, which is either you are or you're working with them if you're in this room, I'm guessing today. We need to be thinking about our strategy for profit extraction going forwards. Because at the lower rate, it's lower profits, it's going to be more marginal. But actually, if this is where we're standing today, saying it's better to pay a dividend, it's not. We need to change that and say it's probably better to pay a salary. Notice I said probably, and that means we've got to look at it. You need to talk to us, we will talk to you, but you need to look at it. And then I thought, why don't we consider what happens? Because when we talk about profit extraction, we often then say, we've got a new client who's saying, should I be self-employed or in a partnership, or should I be in a corporate position? Again, the answer is going to be, it very much depends on where you stand. You never, never, ever do anything just for tax purposes. Never. You do it you structure it correctly to reflect your business and the risk that is right for you. But if you have that choice, and bear in mind that companies are not the only ale around these days, you can have other business structures too, an LLP. Do you want to be in a corporate structure? I'm sorry. So if you're looking purely cash in hand, if you have a company with a salary with that £250,000 profit, you get £127,000 in your pocket. A dividend, you'd get 114. Or if you're a sole trader or a partner, you'd be looking at 143. That assumes, as a sole trader or partner, you take every single penny out, which of course people don't. So we need to look at it in detail in every circumstance. Ooh, it's bored with me now. Summary. So it's been a really interesting couple of days and I've caught up on time, so I've done really well there. First, we thought there'd be nothing to talk about, and then they leaked everything. But Matthew, Jan and I have shared with you today with areas which we thought would be interesting and relevant to you. They impact on us and our wider Cambridge community. The Chancellor said it was a budget for the workforce to strengthen society. As Warren said earlier, of course he said that, because if he didn't, he shouldn't be in the job. What is our ongoing strategy for growth? I'd love to know what the technical reason is that we're not. How did you define what's the technical reason for not being in a recession? I'm sure it's something slightly dodgy, but there we go. But we're in a position the Chancellor can now make these throwaways at his next budget before the election and hopefully give us some stability going forwards. I think we've reached the point where I'm going to say thank you all very much for your kind attention and coming. I also want to thank our team, huge private clients and tax team generally, who have helped us to reach the point we're at today. A lot of them have been involved in the slides and the presentation. We just take the glory. So thank you to you. Also to highlight to you, they're there for helping. If you have a question, please do talk to us either now or afterwards. We'd be absolutely delighted to assist.
Right, thank you, everyone. Sanchia's definition of staying on time is different to some of us, but good effort. So then, thank you for everybody's attention through that. Very interesting comments. Thank you also for those that have sent questions through. I am very conscious of time, so I am just going to pick out a couple of questions. As I said earlier, my colleagues and the tax team will be here for as long as you need them to answer any other questions or some I miss here. So, Sanchia, I'm afraid most of these are going to be business tax.
Oh, good.
So, and you can feel better that everybody's going to be sole traders now, but there's still some questions about
Of course, they'd be a good idea, might not. I think that's a good idea.
So the first question is, if we claim 100% first year allowance, do we have to pay corporation tax 25% on any disposal proceeds?
There is a clawback for the super deduction that you have to be very careful. I think the 100% first year allowance, I don't think there is a clawback. So I think that's one bit of good news compared to the super deduction.
Okay, that's good. And also around the R&D inquiries, which you mentioned, and we are seeing a lot more of those inquiries. What specific sectors do you think they're going to focus on that affect our client base?
Actually, in terms of we are part of the Creston group, and we had a conversation about this, and I think they are looking at construction and they're looking at software-based claims. I think HMRC seems to think that most software-based claims are dubious, so you need to make sure that you need to go into quite lots of details to explain what is really groundbreaking about the software. So I think these are the two areas that HMRC, I'm not suggesting that we share that idea in terms of, but I think it's one of those areas that HMRC are targeting very, very closely at the moment.
Okay, thank you. Matt, just one for you, around someone is admitting, well, or thinking they may have claimed incorrect furlough amount. It's very, very honest of you. Apparently there's a task force that's been abandoned. But what does that actually mean? And they say, well, do we not have to worry anymore? I suspect the answer is no.
The answer is no. It will be part of revenue inquiries. They can look back a number of years. Where we are seeing it, though, is on due diligence. So on trade sales, it's now very much part of the legal questions in the review. And they're quite open-ended questions, and it's, have you claimed the correct amounts under furlough? It's really that's it. So it's very much on the seller to explain exactly what they've done, and then seek to go to HMRC and disclose everything, because there are interest and there are around. So it's not just because the task force isn't there, it's still going to be something that you get caught up on.
Okay, thank you, Matt. And the first question that came through, I think, was any tips on the Gold Cup? Being a good accountant, obviously, I wouldn't go for too much of an outside bet, but I think brave man's game is what I've been told. So, which brave person's game is probably a good summary of trying to describe the budget. Thank you, everyone, for attending today. We're just about on time. Coffee and some late breakfast is still outside. So again, thank you for attending today, and have a good day.